This is Chapter 1, Video 2. Let's launch. So in today's learning objectives, we're going to discuss what constitutes a tax and the general objectives of taxation, and then discuss how we calculate taxes in general. So what qualifies as a tax? This is, we're still kind of in the theoretical realm at this point, but a tax is a payment required by a government that is unrelated to any specific benefit or service received from the government. A very good example of this is basically, hey, for example, maybe the city I live in right now does do snow plowing in front of our streets. I pay taxes in order to allow them to have services that are provided to me, but it's not like I say, gosh, I can do snow plowing in front of my street specifically, so I'm going to go ahead and I'm not going to pay you those taxes. That's not the way this works. The way it works is that they pass a levy. Everyone gets collected on whether they want to pay that or not. And it's kind of seen as we're going to provide those services in order to make things better for our city, but at the same time, it's not specifically identified with that service. So the key components of the tax: payment is required, payment is imposed by the government authority, federal, tax, state, or local, and it must not be tied directly to a benefit received from this taxpayer. Now, where do we see this more often than not is that, for example, if you take a look at a property tax statement from somebody, what'll happen is that they'll have I remember, Maryland has a lot of these where they have certain fees. So for example, they'll have sewage fee, they'll have, so sewage fee, and then trash fee and things of that nature. Those technically aren't taxes because it's a fee that's actually done. And we're going to talk about this later on, but when we talk about personal property or real property taxes, in order for them to become deductible on the tax return, you're going to actually have to pay what's called an ad valorem tax. Ad valorem is the Latin word for based on value. And so that's what you have to be able to use, or you have to be paying your tax based off of in order for you to be able to take that deduction off of it. So as a tax question, which of the following constitutes a tax? Payment for a driver's license is not a tax. That's actually a payment for a privilege. Believe it or not, we don't have rights to drive in the United States. You have a privilege to be able to drive in the United States, and you do that through paying for your license fee. Payment required by the government, house appraisal. That is not a tax because you're obviously doing something that requires that appraisal to be taking place, whether it's a fee that's being done in order to do an appraisal of the value of your house so they can assess tax on it, or if it's you're going to sell the house and so you go ahead and you do a government level appraisal. Actually, appraisals for selling your house generally are not going to be done by the government, but it could be, theoretically, but that's not going to turn it into a tax. So payment for a hotel use of 1% of the bill for city projects, that is actually going to be a tax, because what happens is if you go to a town, actually probably the biggest example that I could think of was Seattle. I used to live in Spokane, Washington. When I used to travel to Seattle to go have yucks, giggles, and fun, or to go watch a Mariners game, what would end up happening is that I would pay a tax in order to stay at that hotel. And usually I think their tax was, I want to say it was like 10%. It was some exorbitantly high tax, but it was a tax that they did because what they were noticing is that a lot of people travel to Seattle and then leave. Well, there's a lot of goods and services that they benefit from that they wouldn't pay for otherwise just through the sales tax. So they went ahead and they did a hotel tax. Payment for rental use of a car, 3% of bill to pay for the roads. That is actually a tax because it's done based on a value that you're actually attesting based on how much you're paying for it. If you want to think about it, it's kind of like a sales tax, but it's specific to a specific good, and they're tying it to those things, and they're basically saying, look, we're going to learn later on, it's what's called an earmark. Basically, they're saying, look, if you're going to drive a rental car in our area, you're going to have to pay an additional tax in order to maintain our roads in order to help us take care of it because of the increased traffic. So how do you calculate the tax? You're going to have a tax rate, which is the level of taxes imposed at the tax base, usually expressed as a percentage. Very rarely are you going to pay a flat amount of tax. It's usually going to be a percentage of something. Now, whether that percentage changes as you go up or down, as you will notice when we talk about regressive, progressive, and proportionate taxes, that'll change, but it's usually a percentage. And then the tax base is what's actually taxed and usually expressed in monetary terms, i.e. taxable income, $100,000, taxable income, $700,000 or whatever. And so the tax is going to basically be the tax base times the tax rate. So there's three different ways to measure tax, and I'm going to go over these. There are three ways to measure tax, and we'll kind of talk about this, but I'll tell you why I got rid of the average tax here in a second. But the three that I tend to use in my practice more than anything else is marginal tax rate, effective tax rate, and capital gains rate. Okay, so the marginal rate, it is what we call the decision rate. It is the incremental tax of that next dollar. So for example, and I take my quick finder that I have here, which is a book that I use. I'll see if I can show this up a little bit. And this is what we call the quick finder. And the quick finder, it's a guide that has all sorts of shortcuts and things of that nature. One of my favorite things that they have here in this little corner right here is the tax table. So it says here that if I am single and I made $84,200 or less, down to $34,476, my marginal tax rate is going to be $22. So if I go from $84,200 to $84,201, that will go up to the next tax bracket, which is 24%. So that next dollar is going to be taxed at 24%, as opposed to the 22% that the dollars before that were taxed at, down to the 39,764, 476. Sorry. And so that's going to be what ends up happening. A big misconception that you're going to have with your clients is that they're going to basically say, well, Kevin, I don't want to make an extra $100,000 because if I do, I'm going to pay higher tax rates on it. So what? My personal opinion is you're going to sacrifice $100,000 so that you can save, 24 cents on the dollar. I mean, that's just ludicrous. It's stupid. Look, I'm going to call it duck a duck. I mean, it's dumb. I've had clients who have said that. And usually when I tell them this, and obviously I don't call them dumb, but I'll say, hey, so wait a minute. So let me see if I got this straight. You're going to give them $100,000 so that you save 24 cents and 24 cents on that dollar. And they're like, oh, now I get it. And then all of a sudden they're kind of like, okay, yeah, that was dumb. I'm not going to do it. And usually that's when they tell me they're dumb and I'm kind of like, well, whatever. So we don't actually worry about that. So that's how marginal tax rates work. Now, you go to average tax rate. Your average tax rate, we don't talk about in this class. I don't talk about it. I'm not going to mention it. It's not going to be on any test. And part of the reason why is in 20 some odd years of doing tax returns, I have never, ever, ever, ever talked to a client about average tax rates. It's just something we don't discuss, and it's not something I'm going to ask you to know. I don't talk about it. If I go to partners and I ask them, hey, what's the average tax rate? Do you know what it is? Actually, I did this to a partner just to find out what he thought. When I said it to him, I said, hey, do you know what the average tax rate is? And he looked at me like, huh? You mean, is it like their average marginal tax rate? And I'm kind of thinking, yeah, we don't need to be sharing this with students. So this is just a personal decision that I have. Most clients that I talk to and most other CPA professionals, they're not going to even mention this tax rate. I'm not going to test it. My personal opinion is ram dump it. And if you see a question on a test that asks you about the average tax rate, it's a mistake. You need to mention it to me, and then I'll go ahead and I'll take care of that. Okay. The effective tax rate. Now, what's the effective tax rate? It is the tax on each dollar of income in total. In other words, it is your taxable income. It's your tax divided by taxable income. That's it. It is stupid easy in that sense. It's the effective tax rate is your tax divided by your taxable income. That is the effective tax rate. And that's and the clients are going to get, when they get their tax returns, and I wish I could show you one. Unfortunately, obviously with client data, I can't show you what it is, but there's going to be a little box at the bottom of their tax summary form. They're going to have the three tax rates that I'm talking about: marginal rate, effective rate, and capital gains rate. And so what we do is, I get clients who come back to me and they go, what the hell are these three rates? Why is this important? I've actually made a video on this. I might share it with you guys. if you guys ask for it. It's a video that I made for my business where I actually explain this to clients. What's the difference between marginal rate, effective rate, and the capital gains rate, and why each one's important? Because let's be honest, all three are very important. And oftentimes when you go to cocktail parties and you hear people after they've had about 3 or 4 martinis and they start talking about, I pay way too much in taxes. My tax rate's at 34 or 32%. And I'm sitting there kind of scratching my head. And, usually when they say, actually, my wife's even gotten so used to hearing this that she'll just kind of grab my arm and say, shut up. Don't say anything to him because he doesn't know what he's talking about. That's fine. But basically what they're doing is they're quoting their marginal tax rate. That's not the tax rate that they're actually paying. It's going to be the effective tax rate that it is. And I'll guarantee $1 for donuts, most people haven't a clue as to what their effective tax rate is. So what we want to do is, we want to educate our clients, make sure that our clients know what's going on. I work hard to actually educate my clients and let them know. And like I said, if I have them come back to me and say, oh, I don't want to make $100,000 because I'm gonna have to pay a higher tax rate. So what? You're going to make an extra $100,000. If you don't want to make an extra $100,000, go do the work. Give me the $100,000. I'll be happy to pay your taxes on that because I'm going to get money out of it. I think it's just ridiculous to be able to do it that way. And that's kind of how we end up doing it. Again, not on this slide, but the capital gains rate is actually something else that we give them. And that's important because if you're going to make a decision whether you want to sell some stock or not, it's going to be very important that you know what your capital gains rate, because if it's a 15% versus a 20% or 0%, it's going to make a big difference. This is going to be where we talk about a little bit about an example. Bill and Mercedes. Mercedes, it's a great car, isn't it? Actually, Mercedes was named after the daughter of one of the founders. So that was actually pretty cool. But anyways, see, you thought you were going to learn only about taxes around here. We're going to teach you general knowledge too. Okay, so you have $160,000 of taxable income, an additional $10,000 of non-taxable income using the 2020 marriage filing rates. What is their average tax due? Obviously, we're not going to ask about average tax. That's ridiculous. I don't even ask for it. And then the effective tax rate. And then if they receive an additional $80,000 of taxable income, what's their marginal tax rate? And so the solution is tax due is going to be computed as it follows. And you'll notice that some books do it a little different. So these ones actually, so some tax rates will actually use the formula you see on the screen. There's actually a different number that they use on this book here. And so, and if we ever meet in person, I'll be happy to show you this. But like, for example, because they're in the 22% tax bracket, they would actually take it and they would actually subtract out $8,283 in order to be able to get that. And so, they would just basically take the, whatever their income is and then minus that out. They're coming to the same number. It's just a different way of doing things. My personal opinion is if you've got the quick finders that you've got here, go ahead and use those. If you don't have the quick finders, you can use this method and you'll get to the right thing. Average tax rates, bunk, get rid of it. Don't even worry about it. Effective tax rates, you're talking 15.75%, and that's going to be because that's their tax divided by their actual income. And then their marginal tax rate, which is 23.72%. And that's because, okay, so I think the reason why it's not a round number like it should be is probably because they're crossing tax rates. And so that's why they're going to come up with that. Normally I would actually work this out if we were in class. Obviously, if I'm not in class, I don't have access to be able to show you this. My system's pretty cool, but it doesn't have the ability to do that. All right, folks. So that's all I've got to say about this tax topic today. We want to say thank you very much for attending this class, and we're looking forward to seeing you at the next video.